Hello and welcome to this Friday's morning market briefing. We've got lots to talk about, but firstly, the European Central Bank, the ECB, holds interest rates at 4% in a contested decision, as well as that traders now scale back bets to 2 Bank of England rate cuts this year. We've got lots to talk about on the charts. Also, lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. The first article to talk about is to do with the ECB. Now, the ECB has now sent a very strong signal that the first rate cut is coming in June. This came following the ECB holding rates at an all-time high level of 4% yesterday. Now, this was a very big decision amidst, a week of very important economic data releases, which of course that we covered and noted to all you guys, and we stayed on top of. And of course, in yesterday's market briefing, we were mainly covering the aspect of the US inflation rate, and the briefing before that, maybe that's when we were really talking about the US inflation rate figure, which of course did come out and showed that of course inflation was at a higher level than previously expected. And as we went into yesterday, many figures had already hinted towards that this was likely going to be the case, that inflation was going to beat forecasts and come in higher than expected, and that inflation was now something that was going to be very persistent within the US economy. And so as a result of that kind of inflation rate figure, we saw shocks across the kind of markets of the world, as of course, we saw a sell-off for US indices and, the reaction on the dollar to the upside, of course, coming in line with, people pricing in those interest rates being higher for longer, because of course, if inflation's high, if inflation's persistent, the best way that, central banks seemingly can deal with that is by keeping those interest rates high, and therefore keeping them higher for longer is something that's very important for the Fed at the moment. So it does seem like we're not going to be seeing any rate cuts coming from the Fed up until maybe the second half of this year, which is a great change from what we were really expecting earlier on. But this article is not talking about US inflation, but why have I just spoken at length once again about US inflation? Well, ultimately it's because now that we're getting this ECB interest rate decision where we're seeing rates stay where they are, which was to be expected. Ultimately, we are seeing some more dovish characters come out from the ECB, and we're actually now hearing some more dovish rhetoric from the ECB itself, from President Christine Lagarde, which of course is a large difference to what we're hearing from the Fed, which is that basically they need to wait longer to see rates, see inflation rates, see economic data, and that kind of thing before they can formulate their decision on interest rates. Whereas what we'll get into in this article to do with the ECB is that basically Christine Lagarde and her monetary policy team are basically already looking at cutting interest rates, and apparently within this most recent interest rate decision, which took place yesterday, certain figures within the ECB were looking to cut interest rates immediately, which is a very surprising move. Whilst maybe at the start of the year we were expecting something like that, later to this week, we were certainly not expecting anything like that. And whilst we have kind of been presuming the ECB to cut interest rates before the Fed or the Bank of England, just as a result of lower inflation figures and lower growth figures warranting maybe an interest rate cut, ultimately we were certainly not expecting that early of an interest rate cut so recently. Certain rhetoric from the ECB has certainly now changed the perspectives of most traders now within the markets, especially in relation to European markets. But as we'll get into this article, whilst we are hearing this more dovish rhetoric from the ECB, at the same time, we're also kind of still affected by that US inflation figure that we did receive this week, which is somehow also weighing on the minds of others at within Europe and European traders. And as we'll get into, basically, despite this more dovish rhetoric that we did see yesterday, ultimately traders are still now pricing in less rate cuts this year by the ECB than was previously expected before this decision. So somehow this decision, this week of economic data has still weighed on the minds of those traders, and has still led traders to believe basically that we're going to see less interest rate cuts than we were previously expecting from the ECB, which is certainly the case. That traders are expecting that for the likes of Bank of England and the Fed, which are dealing with much higher levels of inflation, at kind of more persistent levels, but kind of better growth than we're seeing maybe in the Eurozone. But certainly wasn't really what we were expecting from the ECB, nor is it something you would expect just when you kind of see this kind of data come out. Now, the press conference following the decision saw the ECB President Christine Lagarde, tell reporters that a small number of officials had argued for an immediate rate cut. The press conference also saw a significant change in rhetoric from the ECB, with the ECB saying that it would be close to appropriate to cut rates if confidence grew over underlying price pressures closing in on the ECB's 2% inflation rate target. Since then, since the Eurozone's peak level of inflation in 2022, inflation has fallen from 10.6% all the way down to 2.4%, which is now very close to the ECB's 2% target, of course. Lagarde did, however, go on to say that there were bumps in the road which could cause inflation to fluctuate over the coming months before inflation reaches the target in 2025. Following the interest rate decision and press conference, the euro held before slipping 0.3% to the downside against the dollar, and meanwhile the 2-year German Bund yield rose 0.02% to reach 2.8%. Despite seeing more dovish rhetoric, therefore, from the Lagarde, traders still downgraded the likelihood that the ECB will cut rates in June from 75% down to 70%. And this likely being driven by markets being shaken by the US inflation rate figure that we did receive recently. So, very interesting news in regards to the ECB's interest rate, and a very interesting situation just in regards to, the way the ECB is dealing with the present inflation issues within the Eurozone, as well as growth issues. So, lots to look out for in regards to the ECB, and make sure your eyes are glued to your screen in regards to any news from the ECB, as of course the kind of economy of the world does shape up in an interesting fashion. Next, let's talk about, though, still on topic of interest rates, is the Bank of England, which is in a very interesting position now, as traders are now pricing in only 0.25 percentage point rate cuts from the Bank of England this year. This comes as the policymaker Megan Greenie said such moves were still a way off. Now, this is a very interesting article and a very interesting topic, of course. As we've just came off the article which we were talking about in regards to the ECB's interest rate decisions and that kind of thing. But despite that, of course, in that kind of moment where we were talking about that article, of course, we did highlight that basically, despite traders initially expecting, or at least the ECB expecting, 0.25 percentage point rate cuts this year, traders and were basically now pricing in less percentage point rate cuts this year than was previously expected. Now, I think that figure was around 0.7 or something like that. 70%, 70 percentage point of rate cuts this year in comparison to 75% that were previously expected. Now, something that's important to highlight, of course, in regards to this article is US inflation rate figure that we did receive recently, which, just like we're seeing here now with the Bank of England, drove traders to now expect less than 2 rate cuts this year. It's either now 2 0.25 percentage point rate cuts this year, which are being expected of the Fed, or even just 1 0.25 percentage point rate cut. Now, this was so significant, of course, because this was a large change from the 6 to 7 0.25 percentage point rate cuts that was previously expected from the Fed, at the start of the year and ending off last year. So, we've seen a large change in what investors and traders are expecting of the Fed, most certainly. And here we are seeing, traders now within Britain, starting to scale back basically their bets on, the Bank of England cutting interest rates as much as they already have expected of themselves, and now we're even expecting the Bank of England to only cut interest rates by 0.25 percentage point rate cuts. Pardon me, I kind of worded that very poorly, but I hope you understood what I was trying to get across there. Basically, it's a very interesting situation now shaping up, and as we'll hear from Megan Greenie, basically, she's arguing, as you can see here, that basically, the UK is going to be dealing with a worse inflation issue than the likes of the Eurozone and even, the US. So dangerous times for the UK's economy. With this also coming at a time where international markets have already begun scaling back their expectations of imminent rate cuts by the US and Eurozone over recent weeks. As a result of the new Bank of England comments, traders are no longer fully pricing in the first UK's interest rate cut in August, and instead traders now expect the first rate cut in September. Markets now only expecting 2 rate cuts this year is a significant change from the 6 rate cuts previously expected early in the year during January, of course. Now, the comments from Megan Greenie in conjunction with the US inflation rate figure this week caused the interest rate swaps market to price in 0.5 percentage point rate worth of rate cuts this year, compared to 0.72 percentage points of rate cuts at the start of the week. Now, the Fed, ECB and Bank of England are all expected to only start cutting rates in the second half of 2024. I did, write that. However, of course, we are expecting that not so much to be the case for the ECB, where we are still possibly expecting a rate cut in June, or that's some certain thing, but arguably that is kind of going into the second half of the year, so kind of ignore me there. Now, Greenie's comments, however, must be taken with a grain of salt, with her position on the Monetary Policy Committee always having been more hawkish. So very interesting comments there from Megan Greenie, but of course, we do have to understand that she is one of those more hawkish Monetary Policy Committee members. So lots to look out for, though, in regards to the Bank of England. Next to talk about, though, of course, that's all to talk about in the articles. Next to talk about, of course, is the charts, where we do have quite a bit happening, and of course we are beginning with US indices to talk about, US equities, and of course the Dow Jones more specifically, which of course has been greatly affected recently by the rounds of US economic data which has come out over the past few weeks, and especially over the last week, with that more recent US inflation rate figure, which I spoke about in the first 2 articles, which has affected markets greatly and caused the US 30 to sell off greatly. And as you can see here, that key liquidity zone that we marked out earlier in the week as a key area which price may bound off, but price never reached it, has now been broken through. That said, pardon me, price is now swinging back to the upside, so possibly this was more of a fake out, but certainly the US 30 is now in a very interesting position, as the kind of sentiment is changing to one which is far more bearish, after a time where of course we were seeing a great US equity bullish rally, and we were seeing that kind of across US equities, of course, with the S&P 500 obviously making more gains, but ultimately, still not seeing kind of the levels of sell-off that we're maybe now seeing on the US 30. I did note, of course, how in yesterday's market briefing, how as kind of we saw with this bearish divergence form on the RSI not too long ago, starting off April, we're now kind of seeing this really kind of small short-term maybe bullish divergence shaping up on the US 30 as well. So maybe, we've got this kind of retracement opportunity shaping up on the US 30 before then maybe price continues down to the downside. But of course, we have to remember with these US equities, with these larger US companies, with these, large US equity indexes, ultimately, the companies within them are going to be affected less by interest rate fluctuations than maybe these smaller companies in these smaller indexes. And as a result, their larger cash reserves allow them to be resistant. And so, the changes in the macroeconomic environment don't affect the US 30 and others just as much as maybe the Russell 3000 or something like that does. So, certainly interesting price action on the US 30. Possibly we've got a retracement opportunity shaping up before continuation to the downside. But certain risks obviously do lie in the US 30 at the moment. Next to talk about though is the dollar, which as a result of kind of the euro action yesterday, the euro information that we did get in regards to the ECB price has now kind of pushed higher and then sold off. Obviously, the US inflation rate figure that we did see come out pushed the dollar all the way to the upside on Wednesday, and then yesterday price kind of just continued this trickle higher. But seemingly following that ECB interest rate decision, the dollar is kind of now selling off a tiny bit. Arguably that's just because price can become overvalued during these kind of decisions, and then we kind of see price kind of find its area after kind of the volatility is calmed down. So maybe that's what we're seeing, or we could be seeing kind of this retracement taking place where price is once again hooking back on itself to come into contact with this liquidity zone before then price continues this rally to the upside to reach those areas seen last October and that kind of thing. So lots to look out for on the dollar. Next talk about is Euro USD, which has continued a sell-off following the ECB's interest rate decision and that US inflation rate figure. Surprisingly though, of course, although we did get a great deal of dovish comments from President Lagarde and that kind of thing, we still haven't really seen that overwhelming sell-off that did of course happen following the US inflation rate figure. And arguably that's just because what happened today was what we expected. We expected probably some members of the ECB to of course push those rate cuts immediately, but then we also expected that likely to be postponed until maybe June, and that is kind of what's happened. So possibly price, the euro had already been priced in for this kind of move, and that's why we really haven't seen the sell-off which one might expect. That said, we definitely do have this kind of bearish outlook now in Euro USD, so we could definitely be looking at price kind of retracing back up to maybe this 38.20 level in key liquidity zone before price then continues to the downside. So lots to look out for on Euro USD. Next to talk about though is pound yen, where there's not much to say really. At the moment pound yen really does seem to be consolidating and finding its footing, and any British data that we are receiving today, including the British GDP figure, balance of trade figure, and even the industrial and manufacturing production figure, could definitely move pound yen one way or another. So definitely listen out for those pieces of information and keep your eyes on pound yen. Next talk about though is Bitcoin, which of course has been highly volatile recently, but at the moment just seems to be ranging around. I think it's interesting to be looking at Bitcoin now that we're kind of seeing this more hawkish rhetoric from the Fed, because I think that's largely contributed basically to this slowdown that we are seeing on Bitcoin, as ultimately that change in rhetoric from the Fed is just making those everyday investors into Bitcoin reconsider the kind of risk and volatility maybe in having your money in something like a Bitcoin or Ethereum or that kind of thing, when they know that they can just secure those higher interest rate safe savings accounts. So definitely keep your eyes on Bitcoin though. Lots to certainly come maybe for Bitcoin. Next to talk about though is gold, which is, if I can get onto, is continuing to push higher despite the kind of US inflation rate figure that we did get recently, which of course did create some bearish moves for gold, as of course gold is that hedge against inflation. And so, if interest rates are being expected to be held higher for longer, then of course that's kind of a bearish kind of outlook for gold. But despite that, price is currently pushing for those all-time highs once again, and we've still certainly maybe got a bit to go for gold. So lots to look out for on gold, but somewhat of a bearish divergence is also forming, so keep your eyes on gold. Lastly to talk about though is of course oil, which is kind of ranging around at the moment between these two key liquidity zones. Not much is happening, but certainly with tensions in the Middle East at kind of yearly highs, lots is still to come obviously for oil. That's all to talk about on the charts though. Lastly to talk about of course is the economic calendar, where we are getting a great deal of data today, so lots to listen out for here. Now firstly, we're getting the Chinese balance of trade figure, followed by the Japanese industrial production figure, and then the German inflation rate figure. So a very important Eurozone figure that we're getting there, and that will be definitely pushing the euro one way or another, and will have great influence on whether we now see a continuation on the euro or just see price stay where it's at. Next figure we'll be getting is the British GDP figure, followed by the British balance of trade figure, and then the British industrial and manufacturing production figure. Followed by that, we're getting the French inflation rate figure, and then the ECB survey of professional forecasters, and then the US consumer sentiment figure, and finally 2 Fed officials speaking today with their respective speeches. So we've got lots to listen out for, lots to look out for, but we've covered lots in the articles, lots in the charts, and lots in the economic calendar. That's all from Wildwood Capital though. I hope you have a great trading day and a great weekend. See you later.